Welcome to Money Talk, making good investing easy.
With the end of the tax year around the corner, this episode will focus on investing your ISA or pension, even if you don't have the cash to hand.
I'll be sharing my ISA fund picks.
We'll also look at how to make sure your retirement savings last as long as you do.
Why women still prefer cash.
And we ask renowned fund managers Nick Train and Alex Wright whether investors should be looking for value or investing in quality companies. Art or science? Some would argue that successful investing requires a little bit of both. But many people are worried that they invest their money just before the market suffers a fall. Emily Montgomery has a foolproof formula.
Investing the full pension or ISA allowance can seem daunting, especially if you haven't got the cash to spare. But it doesn't have to be rocket science. The numbers show that investors who actually drip feed their money into their ISA or pension tend to do better than those who invest a lump sum in one go. There's a simple formula. By regularly investing a small sum, you benefit from pound cost averaging. Here's how it works. Invest the same amount regularly, and when prices are low, your money will buy more than when prices are high. You even out the ups and downs. And that way, you don't need to worry if by some stroke of bad luck, you invest the day before the market falls. Markets do that, and that's okay because they go back up as well. You've just got to remember, drip feed money into the market, stay invested, and hold your nerve.
Right, so drip feeding your money into your ISA is a great way of taking the emotion out of investing. But it's not just ISAs, you can save regularly into a pension, and that's a great way of securing your financial well-being in the long run.
The key difference between the two, though, is that an ISA is accessible. You can get your money out anytime you want, whereas with a pension, money is locked away until you reach retirement age. And I guess that's why an ISA is more attractive to younger investors who are a bit nervous about locking their money away.
Yeah, but of course, with a pension, you get generous tax relief from the government. And if you're saving through a company pension, then you could also get a contribution from your employer.
Of course, the big question is how much should you save? In the next clip, Ed Monk looks at how making small changes can make all the difference to your retirement income.
The days of an easy retirement income are fast dying out. In fact, they may already be extinct. Building the pension you hope for is a process that takes time. It can sometimes feel like the small amounts you're saving today will never amount to the big difference that you're hoping for in retirement. But if you're willing to make small changes to your contributions now, you might be amazed at what your retirement savings could evolve into. Here's what a person's pension saving might look like over their career. Starting on an average salary and making contributions required by automatic enrolment, they could expect a pot of around £338,000 when they retire. Not bad, but with small sacrifices, they could more than double that pot. Instead of saving 5% of their earnings, they increase this each year. So 6% in the second year, 7% in the third year, and so on. Repeat these increases for just 10 years at the start of their savings journey, and their pot by the time they retire will have more than doubled. But how easy is it to do? I asked Carolyn Jones, Fidelity's Head of Pensions Policy. Carolyn, what's it going to cost to increase pension contributions in this way?
So saving into your pension earlier can have a dramatic impact on your final pension, and it may not cost as much as you think. So the government give you tax relief. So if you're a basic rate taxpayer, that means for every £1 you put in, it actually only costs you 80 pence. And if you're a higher rate taxpayer, the savings are even more. And your employer might pay extra in, so you need to look at your employer's scheme and they might match your contribution.
And how easy is it to do?
It's very easy to do. So if you've got a workplace pension, ask your employer to deduct it from payroll, and then it will come out of your pay either weekly or monthly whenever you're paid. And if you align that change to tax year end, or if you have a pay rise, then you may not even notice it. If you're in a personal pension or a SIP, then you can change your direct debit. But bear in mind, you can pay a single contribution. So if you do have some spare money at the end of the year, just pop it in your pension.
Your retirement savings might start small, but adapt your habits and increase your contributions, and they could evolve into a completely different animal.
So by drip feeding money into the stock market and making those small changes, I can ensure that I'm saving enough. But how do I actually decide where to invest?
Yeah, investors have to make lots of choices. There's active or passive, shares or bonds, and then of course the debate between a value-based approach or the search for quality or growth. I went to speak to two well-known investors to debate the merits of each of those approaches. Setting sail from the Greenwich Meridian here, the seafarers of old had a choice to make, east or west. Investors have to make choices too, and today one of the big divides is between value investors and those who are focused on quality. A value investor looks for a good company at a great price. A quality investor looks for a great company at a reasonable price. I caught up with two investors on either side of this divide. Alex Wright is a value investor, while Nick Train focuses on quality.
What I'm looking for is companies that are cheap compared to their intrinsic value. So I won't pay up for anything. That doesn't mean I won't ever own quality companies, and indeed I own some companies I regard as very high quality, but for whatever reason the market today isn't actually pricing them as thus.
We would care to own businesses, brands and franchises where we have the highest degree of confidence in their durability and their relevance for customers, not just today but for decades in the future.
Looking for stocks that I think other people have unfairly tarred with the negative brush, and therefore stocks that are trading below their medium-term value.
In previous periods of high and rising inflation, those companies, those equities that did the worst are what people today call value stocks.
The reason that value investing has worked over time is sort of mean reversions. I think what's really key in value investing today more than ever is actually doing the deep underlying fundamental analysis to see if that is the case, there's a potential for mean reversion, or if that isn't going to happen because something structurally changed in an industry.
I would say within reason, you can, with a true investment time horizon, you can at least continue to hold, if not buy more, of these extraordinarily rare companies.
Two investors, two very different approaches. The good news is that you and I don't have to choose. A portfolio built on value and quality will help you navigate even the stormiest of investment seas. Now, if you're looking for some tax year-end investment ideas, you may find my recommended fund picks useful. There's the Invesco Perpetual European Equity Income Fund. It's managed by Stephanie Butcher. She looks for high dividend-paying companies at a good valuation. Then there's the Old Mutual Asia Pacific Fund, run by Ian Heslop. It's a great way of playing the Asia growth story. And finally, Jeremy Podger's Fidelity Global Special Situations Fund, a real stock pickers fund with global diversification. And if you want someone else to pick the funds for you, why not take a look at the brand new Fidelity Select 50 Balanced Fund. It's a fund of funds based on our popular preferred fund list.
With all those investment ideas, I don't think there's any excuse to leave your money languishing in cash. Yet many women do exactly that. In the latest Mind the Gap video, I look at the glaring gap created by steering clear of the stock market in favour of cash. Are men and women from different planets when it comes to investing? Judging by some research, you'd think so. Women are more risk averse, men are more confident. Women are more cautious, men trade more often. But what do the numbers say? According to HMRC, women hold more ISAs than men. Maybe we're just better savers. But women prefer cash, holding far more in cash ISAs compared to men, who hold far more in stocks and shares ISAs. So ladies, we might be good at saving money, but we tend to shy away from the stock market. And that is a problem. With interest rates at record lows and inflation rising, you're losing money in real terms. Now, of course, markets can rise and fall, making the stock market a more risky option than cash. But over the long term, shares tend to outperform cash. So mind the gap. The glaring investment gap left by avoiding risk and leaving your hard-earned savings languishing in cash. Remember to make the most of your ISA allowance, because once the clock chimes midnight on the 5th of April, you would have lost your chance to shelter money from the taxman.
And don't forget to top up your pension too. You can find more guidance on retirement and investment from me and my team on all Fidelity's digital channels. Thank you for watching. Goodbye.
Goodbye.